Yes. Mayura, go ahead and introduce, and then we can continue this.
Okay, sounds good. Again, thanks everyone for joining in. This is a special event where we'll talk about the self-directed IRA. Many of the folks had asked about this in the way to invest using a IRA, the retirement funds. So we have an expert on the call today. His name is Kurt. He represents the company based in Houston. So he will talk more about himself and also the company, and also we'll go through the what advantages this brings us. So again, welcome Kurt to this call, and thanks for taking this late call and scheduling this event. Kurt, over to you.
All right. Thank you very much. I appreciate it and happy to be here. Always happy to give away some education to investors of all types. Appreciate you guys setting this up and having me. Let me share my screen so we can get, we can dive right into this. All right. Can you guys see everything okay? Hear me okay?
Yes,
All
looks
right,
good. Sounds good.
All right. So we'll kick it off, guys. My name is Kurt Power. I'm a certified IRA specialist at Quest Trust Company, headquartered in Houston, Texas. We have offices in Dallas and Austin. We service clients across the United States. And really the point of tonight, when I was asked to do this, number one, again, I was very happy to do it. The biggest thing that I want you guys to take away from this is, though I'm an IRA specialist and I believe in real estate investing, don't think that self-directed IRAs are the end all be all. You know, this is a tool. This is a tool to be used with your overall wealth building strategy, and a very effective one at that, because investing with a self-directed IRA or any IRA, you have to understand it's a tax exempt entity. That's very powerful when we talk about how it is we accumulate wealth. We want to have as much wealth as possible inside of these types of accounts because of the way that the money is growing in that and the tax benefits for doing so. So in this presentation, you'll learn a little bit about me. You'll learn about Quest Trust Company. You'll learn about the types of accounts we offer, but in particular, you're going to learn about how to use a self-directed IRA for the purposes of investing in syndications, things like multifamily, things like self-storage, things like apartments. Believe it or not, if we look at data, I believe data suggests that syndications are really the way of the future. It's already happening, but this is going to be, I think, the most popular investment strategy when we talk about alternative investments, things that are private, real estate, notes, private entities. I believe wholeheartedly that syndication is going to be the most popular passive investment that people, real estate investors, try to use. So again, I'm Kurt Power, certified IRA specialist, director of business development at Quest Trust Company. I've been in real estate for, 8 years now, and really have seen a lot of things, been on both sides of the fence, been involved in many aspects of real estate, but actually got my start in my career was actually in the fitness industry. And though that doesn't necessarily relate to real estate, you have to understand that when you're in fitness as a personal trainer and you're trying to help people change their lives through fitness, what are you really? You're an entrepreneur. You got to go out and you got to hustle to get clients. You got to build a book of business. You have to operate, even though I worked under one of the largest privately held gyms in the world. You have to look at yourself as an independent operator, an independent contractor. So I learned the value of networking very early on. I learned the value of building relationships. And most importantly, I learned the value of delivering on the things I said I was going to do for my clients. I had a lot of great success in the 6 years I was in the fitness industry. One of my clients actually turned me on to real estate. She worked for a company in Kansas City, which is where I'm from, that was buying up real estate assets all over the country. One of the biggest ones they purchased was a company called the REI Expo up in Dallas, and they hosted real estate conferences around the United States. So that's how I cut my teeth in real estate, was buying into that company and ultimately rebranding it into a company that is now is called Think Realty. We built that company from the ground up. We had 5 conferences a year that we would do. both around the US as well as internationally in Shanghai. We did a Wall Street radio program every single day, with a nationwide publication magazine. Think Realty is still to this day the largest media platform for real estate investors. So very proud of the work I was able to do there. And that's really what turned me on to real estate, got me into that bug of I want to be an investor myself. And Think Realty really amplified my ability to network and the ability to build relationships. And it's what led me into where I am now in Houston. First, I was a VP of investor relations for Pinnacle Storage Properties, which is a self-storage syndicator here in Houston. I managed about $45 million of private equity and $175 million self-storage portfolio. If we rewind back to 2020, the pandemic starting, and what that did, I used my parents as a case study. My parents were supposed to retire next year in 2023. They retired in 2020. Why is that? Companies were already starting to go downsizing a bit. They were already going to a bit more of an automation, work from home, things of that. Pockets of the country were already kind of trending that direction. The pandemic accelerated that, obviously. So I started looking around and thinking, what do I think is going to be one of the biggest explosions in real estate over the next decade? And it's retirement accounts. Ladies and gentlemen on this call, there's trillions of dollars in retirement accounts. There's millions of dollars in retirement accounts on this very meeting that we're in right now. That's what drove me to Quest Trust Company. Quest was already my client for years. I had a great relationship with them. And since I've been with Quest has really been a dream job for me because it allows me to do the things I love to do. I get to network, I get to travel, get to meet investors, get to play a part in your success and keep doing the thing I love to do, which is give back. And why I chose Quest when quite literally every self-directed custodian was my client was really the people. You know, I'm a big believer that a product is a product, but it's the people that make the difference. And since I've been at Quest, I've learned very quickly that we are the largest custodian in Texas, but we're the fastest growing in the US. And we're known in the industry, renowned in the industry for having the most highly trained, educated staff in existence. And that starts at the top with our C-level employees, our president, owners, VPs, et cetera, all the way down to the people that answer the phone at the front desk. We have to go through a very rigorous training program just to be able to work there. And that's one of the big benefits of our company is that we, as big as we are still very local and very customer facing, customer service oriented, where if you call us, it's non-automated lines. We have the fastest processing times in the industry at 24 to 48 hours. That's huge if you're a real estate investor because the old cliche, time is money, is very true. So we take that seriously and we have fun while we do it. So we presently have about 23,000 clients across the US, about $400 million in undirected cash, 100 employees spread across our Houston, Dallas, Austin offices, and we're growing every day. So I think the big takeaways I hope you learn from this is number one, how to utilize a self-directed IRA. We're already real estate investors, so we know real estate works. As I alluded to earlier, this is a tool that's going to help you. We know self-directed IRA investing in real estate works. The only question you've got to ask yourself is how are you going to make it work for you? So over the course of this presentation, you're going to learn about IRAs. You're going to see how to invest passively into syndications. But I think the biggest thing that I hope you walk away with is my personal belief system of like, trust, respect. I think you're going to like, trust, and respect Quest and decide that you want to do business with us as well. But before we get into that, guys, disclaimer, got to say this every time. I'm not an attorney. I'm not a CPA. I'm not an advisor. Nobody at Quest can give you tax, legal, or investment advice. I can't tell you how to structure your investment. Self-directed means you're the fiduciary to your account. So we highly encourage you when you're doing your investments, make sure that you vet the investment itself. But take it a step further when you're doing your vetting and your due diligence, do that on the people that you're going to be investing with. That's key. Relationships are key, especially if you're investing money with people. You want to know their track record. You want to know that they're legit. You want to know that maybe they've even had some failures, but what did they do to overcome those failures? How do they communicate to their investors? That's essential. So if a guy tells you he's never lost money on a deal, run the other way. You don't want to do business with somebody like that, because believe it or not, we've all lost money in real estate. Doesn't mean real estate doesn't work. It's just sometimes deals go bad. You have to understand that. So assess your own risk tolerance, do your due diligence before investing into any type of investment, whether you use Quest or whether you use your own money. Due diligence is everything, guys. So who is Quest? I alluded to this a minute ago. We're the largest self-directed IRA custodian in Texas, the fastest growing in the US. We're now over 23,000 clients. We presently hold over $2 billion in assets under administration. 100 plus employees, 34 of which hold the Certified IRA Services Professionals designation. This is a very rigorous program that many of us go through by the American Division of Banking that just kind of shows that we have an expertise as it relates to IRAs. You know, I'm very specific in my knowledge of IRS tax code as it relates to IRAs. Difference between me and a CPA, CPA's got a very broad understanding of tax code. I have a very specific expertise as it relates to IRAs. Big one here, guys, and this is where I say, whether you use an IRA or not, you can still benefit from an IRA. The way you benefit from it, if you're not directly investing your IRA, is you leverage other people's IRAs. The OPM, other people's money, that exists in IRAs. OPI is what we would call that, other people's IRAs. We presently have about $450 million of undirected cash just sitting in accounts waiting to be invested. So when you're thinking about structuring deals and where to find money, self-directed IRAs and retirement accounts are a great place to start. So what is a self-directed IRA, guys? Believe it or not, a self-directed IRA doesn't exist. That's the truth. It doesn't even exist. It's not even a real thing. It's simply a marketing term.
What?
But it means exactly what it states, though. A self-directed IRA, though it's not a type of IRA, as I alluded to earlier, you're the fiduciary, you're the self. You're directing your funds. There's no legal distinction between an IRA at Quest and an IRA that you may have at Fidelity or Charles Schwab or TD Ameritrade. Pick the custodian. There's literally no legal distinction. We follow the same IRS guidelines. The only difference in the IRA between companies is what the custodian allows you to invest in. Schwab, Fidelity, Merrill, those are publicly traded assets, stocks, bonds, mutual funds. Quest, that exact same IRA, we allow our clients to invest in private assets, things like real estate, notes, private placements, cryptocurrency. This offers you some key benefits. First of which is diversification. Everybody unmute yourself. Who's heard of the word diversification before?
Yeah, we keep hearing that regularly.
Everybody's heard diversification, right?
Yeah.
I hate that word. I hate the word diversification because I don't like it in the traditional sense. I'll say that. When we think of diversification, in the classical sense, if you will, we go see our financial advisor, Edward Jones, for example. And what's the first thing our financial advisor advises us to do? Give me all your money, and I'm going to diversify through mutual funds, through stocks. I would argue you're not really diversified. You just own a bunch of stock. In 2008, 2009, 2010, the housing crisis, the recession, the Great Recession, 52% of Americans lost 50% of their retirement. Well, I thought I was diversified. That's what people were saying. I was diverse. If ever diversification was supposed to save us, help us, shelter our wealth, shouldn't it have been during one of the biggest economic crises in our world's history? That's why I don't like that word diversification, because in the sense of financial advisors, I call them financial salesmen because that's what they are. They're selling you on their company and give me your money. Diversification is, yes, you have those publicly traded assets, those stocks, bonds, mutual funds. Absolutely have them. Diversification to me means you've got those on this side of your portfolio, and over here, you've got private assets, real estate, private entities, notes. That's real diversification. You're spreading your risk over multiple asset classes, public and private. So if the stock market goes on a roller coaster, and stop me if you've heard that before, as it's doing right now, every day we find a new floor for the stock market. If you have that stable asset over here, that house, that multifamily complex, the apartment, the self-storage, tangible asset, by doing so, now we're able to ride out that volatility in the market. The housing market is going haywire. Well, then hopefully our private or public investments are stabilizing us. Generally, it works the other way. Stock market's going crazy. Those private assets, they're what allows us to ride out that storm, mitigate our risk. So when you think diversification, I hope you take away that real diversification is having a mixture of public and private assets, not just one. Tax savings, this is what everybody thinks about with IRAs, guys. That it's the tax shelter. It's a tax exempt entity by definition. Holds the same designation as churches, nonprofits, things of that sort. Certain accounts will give you a deduction when you make your contribution. And the way that those earnings grow is either tax deferred or tax free, depending on if it's a traditional pre-tax account or an after-tax Roth account. This is a very key one. Invest in what you know best. I would summarize this in one word: control. Control meaning you're picking the investments. You're in the driver's seat. We may not know how the stock market works, very speculative. Real estate can be speculative as well. But I would challenge it's a little bit more stable when I can see it, feel it, touch it. I can't see, feel, and touch Amazon stock. So if you like to invest in real estate, single family, multifamily, commercial, notes, land, whatever it is you like to do a few deals a year inside the IRA and invest in something that you truly understand, that you truly know, and reap those tax benefits as well as getting true diversification. The last benefit is one that is very overlooked: social investing. Why social investing is important is when we think about investing in real estate, are we benefiting from it? Absolutely, we are. We're creating multiple streams of income that allow us to live a lifestyle that we want to live. Start to live life on our terms more. We are successful. These first three things: diversification, tax savings, investing what you know best, I would argue those are about us individually. It makes us successful. But as investors, we have an opportunity to impact our communities. We're providing jobs to local contractors, fixing up that eyesore property, or refurbishing that multifamily, that duplex, whatever it is. We're hiring local contractors, creating jobs. We're potentially giving people second chance at having a roof over their head. So I would argue that though these first three are very important, they make you successful. I believe that social investing and giving back, that's what makes us significant. And significance is about giving back to everybody. As real estate investors, we have a very, very powerful opportunity to make an impact, not only in our own lives, but in the lives of the others that we impact and touch every single day. So we have 7 types of plans of IRAs at Quest. They can be self-directed individually or partnered together. We break them down in 3 categories: personal, employer, and specialty plans. Personal plans are the ones you're most familiar with in all likelihood: traditional and Roth IRAs. Traditional IRAs are what grow tax deferred. Not paying taxes today, you're deferring it to the future when you take your distributions. Nothing wrong with that. Buy a $100,000 house, I grow that value to $1 million. I didn't pay taxes on it today. I paid taxes when I'm 59 and a half years of age or older and begin taking those personal distributions. Again, nothing wrong with that. Deferring taxes, that's a pretty cool thing. But if I can make that a little bit better, bought that same $100,000 house, I grew it to $1 million worth of value, and I never had to pay taxes on it when I took distributions. That's the power of the Roth IRA. Ideally, you have as much of your wealth inside of a Roth IRA as possible because of that tax-free benefit. We get to pull that money out completely tax-free. Very powerful. Employer plans are for people who maybe they don't work that traditional W-2 job. They're self-employed individuals, or maybe they got that side hustle. This allows you to have a retirement plan for self-employed individuals. A SEP IRA is basically a traditional IRA on steroids. I say that because it's a pre-tax account. The difference is you get to make much larger contributions with the employer plan SEP IRA, $61,000 a year or up to 25% of what you pay yourself, whichever is less. So much, much larger, but you have to be self-employed, have a business that pays you. Simple IRA, we don't see a lot of these. These are typically what we see for doctors' offices, dental offices, chiropractic clinics, small businesses. Allows them to have large contributions as the owner, the employer, but also be able to give back a little bit to your employees as an employer-employee component, whereas the SEP is just an employer contribution. A solo 401k, we're going to talk about this one a little bit later on, but this is really its own unique animal. I say that because this is really kind of the Mac Daddy, if you will, of accounts, because it's the most powerful account in existence. Most powerful account in existence. Large contributions, loans to yourself, checkbook control, exemption from unrelated debt financed income. Pretty cool. Here's the downside. It's the most highly audited account in existence. Because the risk of doing a prohibited transaction is so large, the IRS audits this account more than any other in existence. Don't say it to scare you, say it more so you're aware of it. If you're self-employed, if you don't have any employees, if you can make a contribution to this plan in the first year, or if you're just as a self-employed individual, call us. We have solo 401k experts on staff. We have employer plan specialists on staff that can walk you through those scenarios to know which one's the right one for you. Specialty plans, these are specialty plans. We call them specialty because they're special plans for special purpose. Health savings account and Coverdell education account. Health savings account really is the best of both worlds. You get a tax deduction on your contribution, and you're able to pull that money out completely tax-free for qualified medical expenses. Things like surgeries, doctor visits, eye doctor, dentist, chiropractic, and acupuncture, all can be paid with tax-free dollars. So as part of an overall wealth building strategy, it's just teaching us to pay for everyday expenses with tax-free dollars versus taxable dollars. Coverdell education account. This is for children from the time they're born to the time they're 18. You can contribute to that plan $2,000 a year. They have until age 30 to use that for qualified education expenses, tuition, school supplies, room and board, uniforms if they go to a private school. It can even pay for your Wi-Fi. Believe it or not, if you have children or you're in school yourself, I'm finishing my master's degree right now. I'm on the computer a lot doing research. I'm using the internet. Technically, I could pay for my Wi-Fi with a Coverdell education account. So again, everyday expenses using tax-free dollars. Again, all these plans can be self-directed individually, or they can be partnered together. This vesting, that's your IRA's name. Quest Trust Company, FBO, first, last name, IRA 1, 2, 3, 4, 5, 6. If we're partnering, pooling money together, which is great for beginners or just great for people who don't want to use all their own money, well, then we're going to have both names on there as to an undivided interest of whatever that ownership level is. For the simplistic purposes of this, it's 50-50. So 50% of the expenses we paid for by these IRAs, 50% of the profit we split. So it's you pay your expenses and it's accept profit according to your percentage of ownership in that deal. So we'll go through some of the restrictions, guys. We got to know what we can and can't do. When we talk about what we can't do, we got to be aware of the people restrictions who are disqualified to our IRA. And this is directly from tax code 4975 of the IRS tax code. We break it down. We have you on the left-hand side. Not only are you in everything that you create, an LLC, a trust, a C Corp, an S Corp, you and everything you create are what are considered taxable entities. You work, you pay taxes. Work, you pay taxes. Those entities, LLC, trust, C Corp, et cetera, they're just taxed differently. Over here on the right, we have Mr. or Mrs. IRA. Mr. or Mrs. IRA is a tax exempt entity. Again, same status as churches and nonprofits. Disqualified persons can't enter into transactions with their IRA. You can partner with it, but you can't transact with it. Pretty easy stuff, guys. Look who's disqualified. The IRS makes things very simple, don't they? I don't expect you guys to know this, to write this down in this kind of details. My job as an IRA specialist to know the ownership percentages, what is considered highly compensated, et cetera. We make it very easy, though, so that you can understand who is considered off limits from transacting with the IRA. The first person is you, the account holder. So is your spouse, parents, grandparents, children and grandchildren, their spouses, and companies that any of those individuals owns, controls, manages, or is highly compensated by. It's really you spouse up and down your family tree. The reason for that is those are the people that are most likely to inherit your wealth when you pass away. So they can't transact with this. They can't receive those type of benefits. Those disqualified people, the prohibited transactions are you cannot buy, sell, trade, loan, extend a service, or receive a direct or indirect benefit from the IRA. Means I can't go buy a house and make it my homestead. I can't go up to Austin if my kids are going to University of Texas and buy a little single family home and let them live there. Sometimes they'll say, well, my son lives there, but his roommates are paying the rent. Doesn't matter. He's just qualified from the IRA and he'd be receiving a direct personal benefit from it, even if he's not paying rent. So you just got to know who you can and can't transact with. When we think about syndications, if I'm raising equity on a self-storage property, who can't invest in that? I can't take my IRA and invest in it because I'm receiving a direct benefit, nor can my wife, parents, grandparents, children, grandchildren, their spouses. But it's not family across the board. Brother, sister, aunt, uncle, niece, nephew, cousin are not considered as qualified persons, provided they are not the beneficiary to your IRA. So I'm going to share my contact information at the end of this. This is something that's very key and very critical. If there's questions about this, I'll answer them in the Q&A, but also just leverage me anytime. I'll leave my contact info. You guys can call me anytime to ask questions if there's any confusion of who it can and cannot transact with you. Tons of resources at questtrust.com too. In our education center, we have a specific webinar about prohibited transactions, more of a deep dive into that. Investment restrictions, there's two. I can't invest in life insurance contracts or collectibles. I can't go buy the the Honus Wagner card, the most expensive card in the world. I can't go buy that in my IRA. I can't buy art, rugs, antiques, cars, classic vintage wine collections. I can't do that because these don't really have a hard appraised value. These are much more sentimental in nature. So my neighbor may think his car is worth $200,000. I might look at it and think it's just a piece of junk. So, there's no way to really truly appraise that value. So good rule of thumb, can't take your IRA, invest life insurance contracts or collectibles. So what can you invest in? Really anything you can think of that the IRA can take title to. Single family home, foreclosures, commercial properties, unimproved land, raw land, tax liens, LLCs, LPs, JVs, trusts, secured, unsecured notes, mortgage notes, convertible notes, net profit, shared appreciation, oil and gas, mineral rights, literally anything you can think of, you could take title to, you can do with an IRA at Quest. So let's dive into some problems here. It's going to be the meat part of the presentation. Can IRA investments be taxable? Well, Kurt, you just told us an IRA is a tax exempt entity, right? That's true. Yes, even that tax exempt entity can be subject to taxes, unrelated business income tax. Sorry, it says UB. It should say UBIT. UBIT, unrelated business income tax is what we're talking about. The IRS, in an effort to level the playing field, has said that it's an unfair advantage if I'm running a business inside of a tax exempt entity. Use the example of a church. If that church has a bookstore in it, we've all been to church, so we see the bookstore that's in there, and they're selling crosses, Bibles, things of that sort. Those relate right back to the business, the church. But if that church puts in a Popeye's chicken, a Starbucks, and it's selling food, it's selling coffee, it's selling bagels, it's selling lemon bars and everything else, well, that doesn't relate back to the business at all. So again, in an effort to level the playing field, the IRS in all likelihood would step in and say, hey, church, you have a huge unfair advantage over the guy down the street that's running his Starbucks and paying taxes. So we're going to slap you with unrelated business income tax. Thinking about it from a real estate perspective, what's running a business? The IRS doesn't put a threshold on it. Say I do 20 fix and flips a year. Is that a business? Maybe. It's up to their interpretation. If you're doing 100 fix and flips a year, I think they could argue pretty strongly that's a business. But Airbnb is the one that comes up the most when we talk about unrelated business income tax, because Airbnb constantly being occupied, constantly being maintained. For all practical purposes, it's a hotel. May not have 24-hour staff, but it has people coming in and out all the time. We have to constantly be cleaning. We have to do these different things. It's a business. So if you're running a business inside of the IRA and you pay unrelated business income tax, number one, it's not you paying it, it's the IRA paying it because the IRA owns the asset. But UBIT is taxed at the trust rate, which is about 37.4%. Now, do I still see people do an Airbnb all the time instead of IRAs? Would I personally do it? No, I would not. 37.4%, that's above my threshold of what I would like to pay in taxes. Second way that my IRA can pay taxes is if I'm loaning out personal property not attached to land, thus the mobile home. This is not attached to land. If I'm loaning that out, jet skis, medical supplies, for whatever reason, the IRS says if you loan out personal property not attached to land, unrelated business income tax. But for the purposes of tonight's presentation, we're not talking about either one of those things. That's a good thing. We're talking about UDFI, unrelated debt financed income. This is a subset of UBIT. What this means is, think about debt financed rental income. If I bought a house in my IRA, and I use the house as an example because it's the easiest to give the example of. If I want to buy a house in my IRA and it's a $100,000 house, but I've only got 50, and I had to take on a non-recourse loan for the other $50,000, I'm 50% debt leverage now. It's a mortgage. I have debt on it. What that means is the first 50% that's not debt leveraged is going back to the IRA free and clear of taxes. The other 50% is potentially subject to capital gains tax. But this is where things get to be magic for an IRA, because now if the tax law, or excuse me, if a tax situation has applied to an IRA, well, now the tax laws kick in as well. That's significant because now if I own debt leveraged property, I'm invested in debt leveraged property. I'm invested in storage, I'm invested in apartments, multifamily, commercial, whatever it is, has debt on it. I now get to claim depreciation, losses, expenses, write-offs, etc. Now, granted, I can only claim up to the percent that I'm debt leveraged. So if I'm 80% debt leverage, for example, or 50%, I can't claim 100% of it because I'm not paying taxes on that non-debt leverage portion. I can only claim up to the percent that I am. But by doing that, I can mitigate my tax liability to the IRA significantly. So that's something very powerful to keep in mind, that the IRA tax exempt entity, the tax law kicks in, tax situation kicks in, tax laws now apply. The non-debt leverage portion, IRA free and clear. And through depreciation, losses, and expenses, I'm significantly mitigating whatever tax liability there could be to the IRA. So don't be confused about UDFI taxes. If your IRA pays cash for property, straight up 100 grand property, I spent $100,000 on it, I don't get to claim depreciation, losses, expenses because I'm not paying taxes. So a lot of people will write off IRAs right there, like, well, I don't get the depreciation. I don't get to use accelerated depreciation, cost segregation, all those words that really mean tax deduction. Well, that's right, you don't, but you're also not paying taxes, period. That's why you don't get to use that. So keep that in mind, that just because you may be doing an investment where your IRA doesn't get to capitalize in depreciation, that's not a bad thing because you're not paying taxes. I would argue that's a very good thing. So the solution to it, again, as we illustrated, as I said, IRA can't use depreciation because it's a tax deferred account. There's no tax benefits, just depreciation. If your IRA is subject to UBIT or UDFI, those expenses of depreciation can be used to offset the UBIT tax. You get to use those write-offs. So it's very powerful. And for the purposes of this, we're talking about syndication. Syndication, guarantee there's debt on it. If my IRA invests in that, and it's an LLC is a pass-through entity. They're passing on the taxation to the investors. Well, if my investor is the IRA and it had to pay taxes, it's going to fill out a K1, or excuse me, a 990T, but I'm going to use my K1s to show my losses. My CPA is going to utilize all those losses from my IRA to mitigate the tax liability. Very powerful. Another solution, invest in a C Corp. Invest in a taxable entity. Doesn't really make the tax go away. It's just taxed differently. So keep that in mind. Paying less taxes, that's a solution. The ultimate solution to not paying taxes in the IRA is our old friend, the solo 401k. As I had mentioned earlier, the most powerful account in existence. The Mac Daddy of IRAs is the solo 401k. Solo 401k, with all great, powerful things, my boss, Nathan Long, likes to say, the Spider-Man, with great power comes great responsibility. This is a hell of a responsibility to have a solo 401k because it has its own set of problems and solutions. The biggest problem with solo 401ks is legitimizing it. Legitimizing simply means that if I qualify for a solo 401k, I'm self-employed and I don't have any employees, I'm the employer and the employee. The last thing is I have to legitimize the account. That means I have to make a contribution in the account's first year, whether that's salary deferral on the on the employee side, or profit sharing on the employer side. I have to make a contribution. Contributions for solo 401ks, maximum at $19,500 a year for the employee, and up to 25% of what you pay yourself from the employer. You have to make a contribution that first year because the IRS wants to know that you're using the plan for its intended purpose. So you got to have a business that pays you, can't have any employees, have to make a contribution in the first year. I get people that call me all the time and they say, I've got $20,000 just sitting in my bank account. We'll put it in the solo 401k. And I ask them, do you have a business? Well, no. Well, you can't have a solo 401k then. I mean, friends, the IRS can be pretty stupid sometimes, but unfortunately, they're not that stupid. They'll catch that very quickly. You've blown up your entire retirement account just by doing something as silly as that. The other problems, man, reporting requirements. Why this is such a dangerous account is you're reporting to yourself. You don't have a custodian that you're reporting your fair market values to that could then get reported to the IRS. It's a dangerous responsibility. When you have checkbook control, and that's one of the big allures of a solo 401k, is you get to physically write the checks. And we see this a lot with people who do fix and flips or own single family. They want the checkbook. They want to be able to write checks on the spot. I understand that. But the risk of a prohibited transaction, not saying you will do one, you could do one. If you have a checkbook and you write for an expense for the business and you swipe the wrong credit card or write the wrong check, use your personal card or your personal checkbook to pay for that business expense, you just did a prohibited transaction. So it's a lot of responsibility to stay up on that. The IRA rules still apply to a solo 401k from prohibited transactions, disqualified persons, etc. Record keeping, tax filing, you got to be on top of all of that with a solo 401k. It's running a business, guys, and running a business isn't easy, but if you qualify and you know what you're doing, this can be an extraordinary account. But we really see it's for a niche audience of people that are pretty savvy and they understand the rules and they're okay. They've got kind of that power team of CPAs, attorneys, etc. The advantages, though, now that we talked about all the doom and gloom, let's talk about the advantages. Checkbook control. Well, Kurt, you just said that's a negative. It can be, but it can also be a positive. If I'm doing fix and flips and I own single family and a pipe bursts on a Friday night or a Saturday, well, I can't call Quest to process the payment. I got to take care of it now. So this account can be powerful from that standpoint. Large contribution limits, again, $19,500 a year on the employee side, up to 25% on the employer side. And there's also a Roth component to that as well. That's where we hear the phrase mega Roth 401k. It's in the solo 401k. It's by making contributions and converting it all to a Roth. That's how you're able to accelerate your tax-free growth much faster than solo 401k. Loans to yourself. You can loan money to yourself in the solo 401k. You have to pay it back, though. This isn't like a Rob's account where you can loan money to yourself and never pay it back. You have to pay back the loan to yourself. But the biggest advantage is that we're talking about as it relates to investing in multifamily, commercial, apartments, syndications, exemption from UDFI. if we are invested in self-storage, and I keep referencing self-storage because that's what I cut my teeth in before I came to Quest as a investor relations VP. Typically syndications are 3 years, 5 years, maybe even 7 years or more. Sometimes the money is so good that the voters keep, or the members that are invested keep saying, let's let it ride, let's keep it going, keep it going. We want to be in this forever. If I own that debt leverage piece of real estate in my solo 401k, be it a single family home, a syndication deal, if I own that asset for longer than 1 year, just like that, UDFI goes away. I no longer pay taxes on the debt leverage portion of my income if I do it in a solo 401k. That's very powerful. But that caveat is you have to qualify for a solo 401k first. Self-employed, no employees, and be able to legitimize the account in the account's first year. So as we wind down here, I've been going right about 40 minutes now, so we're right on track here. Actually, a little bit longer. I apologize for that. But the steps, it's very easy to open an account at Quest. Step one is open your account. We get the account open in 24 to 48 hours, and I've extended a coupon code Memorial22 that is going to do one of two things. It's going to waive your account opening fee if you're active or former military. And if you're neither one of those things, it's going to knock $50 off of your application. Pro tip, guys, we're not going to check to see if you're actually active military. Let that be a little seed. Use a promo code Memorial22. Say you're active military, we're going to waive your account opening fee. Step two is fund your account. How are we funding it? Are we transferring money from an existing IRA? Are we rolling over an old 401k? Are we making a contribution? That's the second step. Step three, find your investment. You may have already found an investment and you want to open an IRA to do that investment. You have to fill out your investment forms, a direction of investment and supporting documentations. For commercial investments, that's an operating agreement and a subscription agreement. We want to see the IRA listed as the investor on the subscription agreement. Operating agreement, we want to make sure who manages that asset is not a disqualified person. And then fund the investment. Guys, if you have your account open and funded, you've submitted your direction of investment forms and everything looks good, we'll fund your investment in 24 to 48 hours. Fastest processing times in the industry, guys. Time is money. So we offer multiple webinars a week, every Tuesday, Thursday at noon, self-directed Saturday, every Saturday at noon. We do first and fourth Wednesdays of every month, 6:30. And the first and third Wednesday of every month, we do a virtual networking happy hour. Everything that we do, whether it's a Quest presentation or if we're bringing a speaker from around the country to educate on their particular area of expertise, we archive everything. So if you miss it live, you can always watch it on Facebook, and everything is archived to our YouTube channel as well. Every presentation that's ever been done for Quest is archived on our YouTube channel. So if you miss it in real time, you can always go back and watch it. Or if you watched it and want to see it again, because maybe you have another question or something didn't make sense, you can always go back and watch it again. This is Arnold, my hero. I love this quote. The worst thing I can be is the same as everybody else. As we're wanting to be different than everybody else as real estate investors. We're a little more risk takers. We want to be different. We want to be successful and significant. So use this to motivate yourself. I mean, my hope for everybody here is that you're successful in life and as an investor, but my ultimate hope, and I pray that you become significant by using real estate as that vehicle to make you such. Very easy to get in touch with an IRA specialist, questtrustcompany.com. We have a live chat function where there's IRA specialists literally answering your questions in real time via the chat function. You can always give us a call, 855-FUN-IRAs. Guys, we are the Fun IRA company. We love to pick up the phone and help you. We pick up the phone when things are going well for you. We pick up the phone when you're mad. It's going to happen at some point. Something's going to happen that frustrates you. We pick up the phone then too. We don't run and hide from that. And if you want to get in touch with me directly, there's my email address, kurt.power@questtrust.com. So I appreciate it very much, guys. That's all I have for the presentation. I'm happy to answer any questions. I know we covered a lot of ground. Use me as a resource. I can't say it enough. Call me or email me anytime you have questions on these things. I'm happy to walk you through and let you know what you can and can't do. Remember, I can't give you tax, legal, or investment advice, but I can at least let you know what you can do and how simple and easy the process is working with Quest. So I hope to work with as many of you as possible. That coupon code will extend that through Monday. So turn in your application by Monday with that promo code Memorial22. Save yourself some money and let's get busy with being a part of your overall investing success. So thank you very much. I appreciate it.
Hey, thank you, Kurt. I think that was a good presentation. And we have been recording as well for the folks who joined in late. We'll have the recording ready. There are a few questions on the chat, so I will go ahead and read through those questions, and Kurt, you can answer them. And also, if there are any other questions, you can raise your hand and I'll go by the order we have received here.
I'll run through these. I see them in the chat box.
Okay, yeah.
Will there be any difference in yearly limit for self-directed IRAs? It follows the exact same rules. So if it's a traditional or Roth IRA, if you're under the age of 50, it's $6,000 a year. If it's over the age of 50, it's $7,000 a year. The thing you want to keep in mind is if you have an IRA at Quest and you've got an IRA at Fidelity, you can't double up. The IRS views that as one account. So you can't do 6 at Quest and 6 at Fidelity for $12,000. So just keep that in mind when you're making your contributions to the IRAs. If you hold multiple of them, it's a maximum amount of $6,000. And that applies when we talk about traditional and Roth. It's not 6 and 6 to traditional, 6 to Roth. It's 6 total combined as an aggregate. So just keep that in mind when you're looking at contributions. Very good question. Already have an IRA account. How do you make it self-directed? Simple. Open the exact same account at Quest and we transfer the funds as a free service to you. So if you've got a traditional or Roth IRA already, we would literally open the exact same traditional or Roth IRA at Quest. Again, self-directed is just a marketing term. It's not a type of IRA. The self-directed really means though that you're in control of picking the investments that you want to do. That's the only difference. We allow you a different asset class to invest in. So same IRA, we would open 24 to 48 hours. It's open. We can then fund your account via transfer. Real estate investment allows us to take some tax benefits such as depreciation. With self-directed IRA, I will not be able to take benefit. How does self-directed IRA cover it? Again, remember, an IRA is a tax exempt entity. So if I buy a property in my IRA that's $100,000 and I buy it for $100,000, I don't get to claim depreciation because I'm not paying taxes. If it's debt leveraged, $50,000 debt leverage on a $100,000 house, or I invest in a commercial syndication that has 80% debt on it, that's when my IRA gets to claim it. If I own or invest in a debt leveraged property, I get to claim up to the percent that I'm debt leveraged. I can't claim 100% of it because I'm not 100% debt leveraged. Up to the percent that I'm debt leveraged, I can claim. And by doing so, I mitigate my taxes significantly to the IRA. That other portion is going back to the IRA free and clear. Okay. Minimum number of years or minimum money accumulation required before you can start self-directing IRA or Roth IRA. You can start investing with an IRA day one. If you have the funds in there, you can start investing day one. At Quest, we don't have any account minimums. We don't say that you have to have at least $50,000 to invest with us. You could have $20,000 invested and have a cash balance of zero. You have an asset in there. That's the whole point of self-directed IRAs. They sit in non-interest bearing accounts at Quest if the money's undirected. It's just sitting there. It's not earning anything. That should be incentive to go find an investment, because your account value will grow when you find investments that are profitable that you do with the IRA. So the things you want to be aware of with restrictions or rules, you have to be 59 and a half years of age or older to take distributions. In a traditional IRA, if you're 59 and a half years of age, you can take penalty-free distributions. You'll pay taxes. There'll be tax at ordinary income. If you take it out before 59 and a half, you'll pay a 10% penalty and pay taxes. Roth IRA, this is very, very critical. You must be 59 and a half years of age or older and have the Roth IRA open for 5 tax years before you can take out your earnings tax-free. The money you personally contribute, your checking account, savings account, that $6,000 or $7,000 per year, that can come out anytime tax-free because you've already paid taxes on that. So I can put $6,000 in a Roth IRA right now and take it out tomorrow for whatever reason I want. Your earnings, though, which is what we really want with the Roth IRA, 59.5 and 5 tax years before those distributions can come out completely tax-free.
Yeah, just to add to that one, Kurt, so the minimum dollar, again, the folks here on this call, there is a syndication happening for a multifamily investment. So people interested to invest in that are opening the SD IRA. So the funds won't be sitting idle. So anything coming in this
Perfect.
account will be invested into that multifamily. So
Perfect.
that's the idea behind this call.
Awesome. This next question, can we move partial funds from individual 401k to self-directed IRA? In fact, I have both individual. So you're talking about having a solo 401k and a self-directed IRA? Absolutely, you can. Absolutely, you can. We see that all the time. We see people that have Roth IRAs and they have the solo 401k. Many times you have, but to have the Roth solo 401k in your plan documents, you have to have provisions in there that you can make Roth contributions to it. So just keep that in mind. If you have a solo 401k, that you have it in your documents that you're allowed to make after-tax contributions to it. But yeah, you can have a self-directed IRA and a solo 401k at the same time. We see that all the time. Can you withdraw from your current 401k? Great question. We know with our old 401ks, 457s, 403bs, whatever they are, if I no longer work there, I quit, got fired, resigned, retired, whatever it is, I can take that money now. I can move that with no issue. If I'm still employed by the company, you have to ask them if they'll do what's called an in-service rollover. Many times companies will not let you do it. Sometimes they do let you do it. And if they do, it's generally up to a certain dollar amount or percentage. So the only way to know from your current 401k, ask your human resources department or go right to the 401k plan provider and ask them if they allow for in-service rollovers. If they do, great. We'll make it very, very easy for you. Just roll that money over. Very simple. Invest in LLC. Is it same for S Corp? Which is better, LLC or S Corp, in terms of what availing tax deduction? It's a great question for your CPA, tax advisor. You know, they're just taxed differently is all. That's the best I can tell you as an IRA specialist. I can't tell you which is better. I mean, that's ultimately depends on the investment, depends on what it is you're trying to achieve, depends on how you're trying to structure it. You know, most syndications are done through LLCs. Most that I've seen. Every syndication that I was a part of directly was a single purpose LLC. Most syndications I see are LLCs. Don't be scared of the fact that they're passed through entities and they pass the taxation on to the investors. I look at it different. I say kick ass means you're making money if you're paying taxes. And inside of an IRA, because as we've illustrated, it becomes even more powerful because you get to claim depreciation losses and expenses now. So that becomes very, very powerful. But in terms of which is better, I would be comfortable with you talking to your CPA and kind of having a deep dive into that to see which really is the best for you. Any costs involved for your services? Yeah. I mean, we are a for-profit company. I'll tell you this, our fees are some of the cheapest in the industry. Normally it's $100 to open the account. We know with that coupon code, we're either slashing it in half or slashing it completely. We charge $125 to purchase the investment. So if you guys want to buy shares of a syndication, we charge $125. What is included in that service is our transaction specialist and private entities reviewing your direction of investment, which is the legal form you fill out for Quest, showing you want your IRA to do the investment and you want us to process it on your behalf. We also review that operating and subscription agreement. So we just want to make sure that everything is done above board so we can make sure nothing is blatantly prohibited. When we fund it, when we send the funds from your Quest account over to the new investment, it's a standard outgoing bank fee, $5 for a check, $30 for a wire. Annual administration fee, $350 a year. The average client at Quest spends about $500 a year with us. That's it. I don't charge a fee for money coming into your account. I don't take a percentage of your profit. That is yours. We just charge those fees, 4 fees, $100 to open, $125 to purchase the investment, outgoing bank fee to fund, $350 a year to hold the asset at Quest, and make sure that you're in compliance, do all the reporting, etc.
Just a follow-up question to that one, Kurt. So can we do multiple investments in a year? And I understand there will be, for every investment, there will be $125 charge. But the yearly fee, does that depend on number of assets I'm holding? Or is it a flat fee for any dollar value, any number of assets?
Two options. Option one is at $350 per year. And the reason I mentioned that is because typically syndications are $50,000 minimums that I've seen. So the other option is a quarterly fee based on your total account value of assets and cash left over in the account. If you start doing multiple investments with your IRA, say I end up doing 2, 3, maybe 4 investments a year, now it might make sense to switch over to the quarterly fee. That can become more cost effective the more investments you have versus paying $350 for each one that you do. Take a look at the quarterly fee. That might be more advantageous for you. So we give you the flexibility because we want you on the most cost effective plan. You can switch at any point in time and it will never cost you anything to do so. And when I'll share a link to the application to be sent out to everyone, the first thing you see is our fee schedule. And you can see that quarterly breakdown to know that I'm being honest with you, at $50,000 minimums and typically 3 to 5 years, $350 a year is the cheaper of the two. Can you have a custodian Roth IRA? Would that be separate, limited? So when we look at Roth IRAs, I think if I'm reading this correctly, so it's not 6K per family, it's 6K per individual. Because remember, IRA means individual retirement arrangement. So if I have a family, myself, my wife, and I have 2 kids. Let's say my wife doesn't work. Let's say I make a ton of money and I've reached that point in life, my wife doesn't have to work. Well, the requirement to make a contribution to an IRA is having earned income. But if my spouse doesn't work, but I do, and we file jointly, she can have an IRA now, or he can have an IRA, whichever one doesn't work. If you both work, cool, makes it easier. You both can have a Roth IRA. Kids can also have Roth IRAs. Now, a lot of times people will say, well, you have to have earned income though. Well, how many grandparents do we see that open Roth IRAs for their kids and their kids don't work? The IRS is not looking at children's Roth IRAs and trying to say, hey, you don't have earned income. This is a prohibited transaction. IRS is much more concerned with people who are doing egregious prohibited transactions. Cost of doing an audit is $8,000 or $10,000 that the IRS has to pay. They're not auditing children with Roth IRAs. So that's not low hanging fruit to them. So I would say that if you have a family, yes, you can all have Roth IRAs. Next question. Annual income limit for self-directed IRAs. Well, let me Google that because they change the phase out limits all the time. And this really relates to, do you get a tax deduction on your traditional IRA? Okay, so for 2022, traditional IRA, single people with a modified adjusted gross income of $68,000 or less, and joint filers with income up to $109,000 can deduct their full contribution, $6,000 or $7,000 a year, depending on their age, for 2022. Deductions thereafter decrease and phase out completely once you're single, making $78,000 a year or more, $129,000 or more for joint filers. So this is where I would propose to people that if you open up a traditional IRA and you're phased out from making a contribution to it and you don't get a deduction, open a Roth IRA, make a contribution to that and have it grow tax-free. Well, the follow-up question is probably going to be, well, what's the phase out limit for Roth IRAs? I believe for families, it's $209,000 a year. And single, I'd have to look that up. But the point of what I'm trying to say with that is, even if you make too much money to make a contribution to a Roth IRA, there still is a way for you to do it. It's called the backdoor Roth conversion. What that means is you're making an after-tax, non-deductible contribution to a traditional IRA. And as soon as that's funded, you convert it to a Roth. That's how high income earners can still have Roth IRAs making contributions. You got to be mindful that every year I'll see people that will do that around tax time. They'll say, hey, I need to open a traditional IRA so that I can do my backdoor Roth conversion. When you file your taxes, make sure you fill it out at 8606. that will show that you made an after-tax contribution to a traditional IRA to convert to a Roth. Therefore, you are not taxed twice. You're using after-tax dollars to contribute to a traditional simply to convert it to a Roth. Yes, you can open up an IRA for your children. You can open up a Roth IRA or a Coverdell education account. Coverdell education is $2,000 per year per child until they turn 18. Roth IRAs are $6,000 a year. So just kind of figure accordingly which one sounds more appealing to you. There's no wrong answer, but which one's more appealing is the option you should go with. And minimum age to open an IRA, there's not. Again, earned income is technically the thing that you have to make contributions to it. But guys, I see it all the time. I see people open up Roth IRAs for their kids. I see people open up Roth IRAs for their grandkids. They're not low-hanging fruit. The odds of those being audited and something bad happening is very minute. Don't take that as advice. Just take that as a factual statement more than anything else. Is there a cap on the amount you can invest? No caps. The only thing that has a cap is those contribution limits. 6,000 for Roth and traditional employer plans. It's $61,000 or 25% of what you pay yourself for a SEP. 13,600 a year for a simple IRA. Solo 401k, 19.5 employee, 25% of what you pay yourself employer. HSAs is 3,600 for single, 7,200 for family, those, and 2,000 per year per child for ESA accounts. So there's no cap on how much you can invest. There's no cap on how much you can earn. There's no cap on how much you can transfer or roll over. Just those personal contributions are the only thing that have a hard cap on it. Yes, you can create a self-directed IRA even if you have a company-sponsored 401k. Guys, I have a 401k at Quest. I still contribute to my Roth IRA every year. I still put $6,000 away every year in my Roth IRA. So yes, you can have both separate accounts. If you have a 401k, take it. It's free money. But open up a Roth IRA. That's my biggest takeaway with IRAs. Open up a Roth, get as much wealth as possible in it so it's tax-free. Not just for you, but when you pass away and pass it on to your beneficiaries, they get that same tax-free benefit. Is there any other questions, or is that all of them?
Yeah. And also, I think timeline-wise, can you briefly talk about that, Kurt? How long does it take once you submit the application? Because there are some Vanguard's IRA to SDIRA, and there are some 401ks to IRA. So how long does each type of transaction take? Is it weeks, months? Or?
So everything at Quest is 24 to 48 hours. The unfortunate thing is I can't tell you how long it takes the other custodian because they're all different. Fidelity, it's typically 3 to 5 business days. They work very quickly. Wells Fargo can take a month just to wire funds over to us. But I'll tell you this, if you call your custodian after we've initiated the transfer, and you as the client call Fidelity, Schwab, Merrill Lynch, whoever it is, and you ask them to expedite the transfer of funds to Quest because you have an investment you cannot miss the deadline for, they're going to send it over to us much sooner. Simultaneous to your funds arriving, that's when we knock out the direction of investment, we review all the investment documentation. That way that's taken care of. So when the funds do arrive, now we can quickly fund in 24 to 48 hours. Rollovers are a little bit different because the client will initiate the rollover. You simply call that 401k plan provider and you tell them that you would like to roll over your 401k to an IRA at Quest. You give them the account number. This is the unfortunate part about these types of plans, 401ks, TRS, 457, 403b. They send a physical check made out to your IRA, but they send it to you first, and then you send it to Quest. I do not know why they do that. It's just the way that they do it. You can ask them if they can send the check directly to Quest. Sometimes they'll say yes. Most often they don't. They just send it to you. And depending on where you live in the country, I would encourage you to overnight it to Quest. Even if you live in Texas, I would say overnight it to us. That way it gets here sooner because the mail has been ridiculously slow for almost 2 years, over 2 years now. So,
So when I say check, do we have to cash it out and then give a personal check to you, or is just pass the check to you?
so what they'll do, they make the check out, say I'm rolling over my 401k. That 401k check is going to say Quest Trust Company, FBO, Kurt Power.
Okay.
Or it's going to say Kurt Power in my account number. So it's made out to the IRA, which means I don't endorse it. I simply take the check, put it in an envelope, and I mail it to Quest. Once we receive it, we deposit it into your IRA account.
Okay. Anyhow, most of the folks here on the call are local to Houston, so we can just drop by your office and then give it to us.
Even better. Yeah. Even better. If you live in Houston, Dallas, Austin, anywhere where we have an office, if you're in the vicinity of those, always much easier. Just drop it off. We'll get it there. Checks do have a 5-day mandatory hold, though. All bank issued checks have to be there for 5 days before they can be sent out for investment. So keep that in mind when we're talking about timeline, that we'll do everything we can on our end for 24 to 48 hours, but the rollover is the part that's going to take the longest.
Got it.
Excuse me.
Okay, I think that's all the questions we had. Just if anyone has any additional questions, again, unmute yourself and you can ask the questions. We'll just give a couple of minutes.
Hi, Mira. Hi, thank you very much, Kurt, this is Praveen. Let's say we roll over the 401k with our old employer to the Quest account. Can we invest this amount what we have in the Quest account to any like real estate investment? Is it possible?
Yeah. So can you take your IRA at Quest and do any kind of real estate investment? Is that what you said?
Yes, right.
Yeah. Yeah. So you can do single family, you can do notes where your IRA is essentially the bank and you're loaning it to borrowers. You and your borrower negotiate a percentage of interest being paid back to the IRA. Typically it's secured by the asset what you're lending on. So if your borrower doesn't pay you, just like if I don't pay my mortgage for my house, they're going to foreclose. So you can foreclose on your borrower. You can invest in passive syndications. You can really do anything you can think of that your IRA can take title to, whether that's physical property, raw land, loans, syndications, oil and gas, mineral rights. You have a lot of options at your disposal that you can do with an IRA at Quest.
Okay. So when can be withdrawn? Is it like something same as 401k timelines, or is it something different?
Sorry, say that part again.
So the 401k you can withdraw after 65, right? So let's say if you roll over the old 401k, it's going to be something similar like that. I mean, if you roll over that amount to Quest IRA.
Yeah, if you have an old 401k, you can roll over however much you want or how little. It's not an all or nothing thing. If you want to roll it all over, you certainly can. But I would say if you only need $50,000 to do an investment and you've got 200 grand in your 401k, you probably don't want to roll it all over to Quest because $150,000 that's just going to be sitting there earning nothing.
Right.
So just keep that in mind when you're looking at how much you need. Roll over or transfer the amount you need before you do anything. You don't want to have anything just sitting there idle.
Right. No. My question is on the withdrawal side. Let's say, after 5 years, if I want to withdraw the money, is it possible, or we need to wait for till?
You got to be 59 and a half years of age. That's the golden number is 59 and a half. If you're under the age of 59 and a half and you take a distribution from a traditional IRA, you're going to pay a 10% penalty and be taxed at ordinary income.
Okay, got it.
If you're
to answer
older,
question, it's another type of retirement account. So again, all the retirement rules.
And Roth, it's 59 and a half and 5 tax years before you can take your earnings out tax-free.
Okay, thank you, Kurt. Those are the questions. Thank you.
Welcome. Thank you. What would be the easiest way of sharing the application? Do you want me just to email it to you and you can share it with the members?
Yes.
Okay.
Kurt, please share whatever you have to share. I will share with everybody.
Perfect. So what I'll do is I'll send you a link to the application and that coupon code, and just keep in mind that coupon code expires Memorial Day. So take advantage. That's the best thing I can tell you is take advantage of that.
One question from me, Kurt.
Sure.
With the other IRAs, people can invest in the stock or mutual funds. Can we do the same thing from
publicly
this
traded? So most of our clients have an account with Quest. They also have that same IRA at Fidelity. The reason I do that is because if I have a Fidelity IRA, I can't go do a passive syndication. I can't do a private syndication just like my IRA at Quest can't go buy Apple stock or mutual funds. So most of our clients will have an account with Fidelity where they take their cash that's just sitting at Quest. Maybe they don't have enough to go do another investment. They move it over to Fidelity to get it into the market where it has a chance to earn something. They use the IRA at Quest to go buy those private assets, real estate notes, private entities. So that's the biggest distinction is while the money is just sitting there idle, I would highly encourage you to get it over to Fidelity, for example, and get it into the market where it has an opportunity to earn something versus guaranteed to earn zero at Quest.
Okay. The next question is, we know we can move from Fidelity to Quest. Can we do the other way around? Move
Absolutely.
from Quest to Fidelity?
Absolutely.
Okay.
That's what I mean. If you have idle cash, let's say we start having some earnings from this investment, and let's say it's 7% cash on cash in year one, and my IRA gets that cash on cash return. Probably not enough to go do another private investment. You would fill out Fidelity in this case, or whoever that custodian is, use Fidelity as the example. You'll fill out Fidelity's transfer paperwork, and Fidelity will initiate that transfer with Quest, and we'll send the funds over to them.
All right. All right. Mayura, you back?
Yeah, sorry, my computer crashed and I could not hear that last bit. So I heard the last question. So the transfer in, transfer out, each has a fee, right, Kurt?
Transferring into Quest, we don't charge a fee. That's a free service. When money leaves your account, it's either $5 for a check or $30 for a wire, just a standard outgoing bank fee. So if we're sending money to Fidelity, the client is going to fill out Fidelity's transfer paperwork. Fidelity is going to initiate that transfer with Quest. We'll send the funds over to Fidelity. If we're moving funds from Fidelity to Quest, you'll fill out Quest transfer paperwork. Quest will initiate the transfer with Fidelity to move the funds over to us. So whoever's receiving the money will initiate the transfer.
Okay. So in the multifamily investment, so we do receive the multifamily investment will give us quarterly dividend payments. So that will come into the SD account.
Correct.
So that is not charged, right? There's no cost to get those funds into the account.
No, we don't charge any fees whenever money comes into your account. So if you make a contribution, you have earnings, you transfer money in, roll over money. We don't charge a fee to accept money. You know, our goal is not to nickel and dime our clients. I mean, we charge those 4 fees, and that's the fees: $100 to open, $125 to process, bank fee, and then your annual administration. We don't take a percentage of your profit. We don't charge a fee to accept the profit or any money coming into your account in any way. We don't take a fee for that.
Okay. And how do we pay the annual fee? Is it a separate check we need to send out, or you are withdrawing from the SD?
You can pay the fees from your account. A lot of people do that. Or you can pay it with a credit card. Most people pay with a credit card because they don't want their account value going down to pay fees. You can pay your transactional fees with a credit card. I mean, we require a card to be on file just in the event that all of your funds are invested. We still have a way to process our fees, but you have the choice. You can do it either way. You can pay it from the account or a credit card.
Okay. I'm trying to think through this one. So if I invest 50,000 and then transfer the 50,000 into SDIRA and invest that 50,000 into the multifamily asset, and they send a quarterly dividends. That quarterly dividends come to the SD account and they get accumulated there, and they're not generating any interest on that accumulated value. So I can use those funds to pay for the annual fees.
You certainly can. Or what most people do when they have money coming back into the account that maybe it's not enough to go do another investment on the private side, transfer it over to Fidelity and get it into the market. Either way is fine.
Mm-hmm. Okay. Yeah. Cool. Okay. I think we had all the questions. So will you be able to share the presentation as well, Kurt?
Pardon me?
The presentation you showed us, will it be shareable? Can you share that?
Yeah. I'll email you the link to the application and I'll send you the PowerPoint.
Okay, perfect.
So yeah,
Okay.
well, I appreciate it, guys. If anybody needs anything, I see that my contact information has been shared. Please take it down. I mean, literally call me, email me anytime. I want to help you any way that I can. Again, I can't give you tax, legal, or investment advice, but I can educate you on the IRA process. I can educate you on the IRA, what it can do and how powerful it can be for you. So I appreciate you guys having me tonight. I gotta go play husband and dad now, and it's been a pleasure, and I hope to do it again soon. And I'll definitely email you the PowerPoint and the application as soon as we're off here. Okay.
Okay, sounds good. And the discount
Thank you,
one,
Kurt.
Kurt, can we extend it because it's a holiday weekend? I think a few folks will need some extra time.
I wish I could, but it's specifically for this holiday weekend, so that code does expire Monday.
Okay.
So take action, guys. If you have questions, email me, call me. I mean, I answer emails on the weekend. It doesn't take much effort for me to email you if you have a question. So if there is specific questions that come up and it's a Saturday, a Sunday, a Monday, when we're closed on Monday, I'm going to respond to you. So take heed and use me as a resource. That's the best I can tell you. But yeah, that code, if we want to open accounts, we've got to have them in by Monday at midnight.
Okay. Yes,
All
you were
right.
saying so. So
No, that's all. I wanted to just say thank you to Kurt and also Mayura for organizing this.
Absolutely. You guys have been awesome. Very good hosts, very good questions. A lot of people on here tonight. I was thinking there's gonna be like 6 or 7 people, and there ended up being about 25 at the peak. So credit to you guys for joining us tonight, and can't say it enough. Thank you very much for having me, and we'll see you down the road. And please, guys, email me, call me anytime. I'm here to help you out.
okay, sounds good. Thank you so
All
much,
right.
Kurt.
Thanks, everyone.
Good
Have a great
luck.
night. Thank you.
Yeah. Thanks, everyone.